Hey, good morning, everyone. Marty Mazzora here. It's the 26th of November, Wednesday, 2025, with a very brief update for you on this shortened holiday week. So, folks, giving you quite a bit of content the last 2 or 3 weeks around what we feel is really moving the market right now, at least on a short-term basis. And all of the actions since that kind of summary narrative that I offered up on the written blog pretty much confirms what we were thinking. And we think in the near term, all else equal, the market is responding first and foremost to the prospects for a Fed rate cut in December. The chart in front of you, I think, vividly expresses that. So the blue line is the S&P 500. The white line is Fed funds futures pricing of a rate cut in December. So now when they're pricing in a cut with this particular graph, the lower it goes, the higher the odds of a cut. Okay, so this going down means odds are going up. And so this just covers us, the last couple of weeks or so. And I drew this red line right here at 50. And remember, I was talking about how dramatically the odds had shifted from around 70% all the way at one point down to like 27% chance of a Fed rate cut. And you can see as those chances were dwindling, you can see the market dwindling notably. So that's that 3 or 4% correction that we had. I think that was virtually all about Fed funds futures pricing in very, very low odds of a rate cut. And then as that began to change, as 3 or 4 speakers came out and said, yeah, we think a December rate cut is on the table, if not likely. You can see what happened. As the odds of a Fed rate cut increased to 81% as I speak to you here today, from 27% literally just 5 or 6 days ago. And you can see what the S&P 500 has done since. So, as I like to say, it does not take rocket science to figure this one out, just based on how the market's been trading for some time now. So, question is it more about the stock market reacting to the Fed or the Fed reacting to the stock market, right? And remember, my narrative is that this Federal Reserve, last thing in the world they want to be blamed for is the catalyst that broke the equity market, that the way the equity market is positioned in the country and globally, in fact, and the nature of a K-shaped economy and things that we've talked about, if this market cracks notably, that could actually be what brings on the recession, as opposed to a recession bringing on a bear market in stocks. So with the intense criticism that the Fed is receiving, that they're late to the ball game and so on, while they are concerned about, we'll call it sticky inflation prospects going forward, they are, I think, going to bias the labor market. And while the October jobs number and even looks like the November jobs data is going to be delayed a couple of weeks into December, the underlying supporting data is suggesting a real weakening there. I'll show you more evidence of that in fixed income here in a second. And so I think it's amazing that a mid, not even quite mid single digit, low single digit drop in the S&P 500 immediately got the Fed's attention. I do believe that's the case, and I do believe that they're looking at forward-looking, labor market data and saying, yeah, we probably could get away with it at least in December. Anyway, the market is reacting quite positively to that news, more so than anything else. Okay, so then speaking to the market, like I said, this one's going to be quick, so I'm jumping straight to, for the moment, the daily one-year chart of the S&P 500. So you remember the other day when we were breaking down here with momentum, I said, folks, do not be surprised, as ugly as this looks technically, do not be at all surprised to see this thing come roaring back and recapturing the 50-day moving average once again. And that would likely be on rising odds that the Fed is going to cut rates in December. So we got that there. We still have all the negative looks that I've talked about on momentum and on the weekly and monthly charts that do not tell a rosy picture, technically speaking, for the next few months, let's say. But right now we're talking about, the next few weeks. Same thing with the NASDAQ 100, in this case, the ETF that tracks it. You can see, same thing, just came back, even caught that all-important short-term 20-day moving average. It is sloping down, but as I talk at you today, it has recaptured it, and this looks like a false breakdown with potentially further upside if this sentiment continues here. Also, I should say that sentiment got pessimistic in a hurry while this was falling. And so now you have perhaps people hedging. Some people went short, people got out of the market, cash gets built up. Oh, wait a minute, the Fed, now there's an 80% chance of a rate cut. We're going to miss the Santa Claus rally. And so you get this kind of panicky buying coming back in. Okay, so let's take a look at the 10-year Treasury yield. Notice it has dropped notably here of late. Now, by the way, folks, this does not reflect the Fed's prospects for cutting rates. This, in fact, would inspire the Fed to cut rates. Remember, by and large, when the Fed's doing its job, it is not leading longer-term yields. It can't, quite frankly. In fact, it can mess it up. Remember last September, 50 basis point cut. Next thing you know, mortgage rates are up 1%, and the 10-year was surging higher, right? Why? Because they were cutting at the wrong time. They were cutting at a time when there was underlying economic strength and inflationary pressures. We did not have the bond market telling them they can cut. Right now, we actually do have the bond market telling them they can cut. And so why are yields dropping? Well, it would be because of what I talked about, the weak forward-looking or preliminary or under-the-surface employment data. And here it is reflected in the U.S. Economic Surprise Index that Citigroup puts out. So this is a one-month picture of that. So as you can see, the data that has come in has been worse than economists' expectations. So meaning that's what the surprise index is all about. It takes a look at the data relative to what economists had estimated. Notice how the 10-year yield follows here, at least recently more so, the decline in the economic surprise index, meaning that bonds have been bought on the prospects of a further weakening economy. And this is a signal that the Fed gets a green light probably to cut rates at least in December. The dollar, very yield sensitive right here. The dollar will move for different reasons at different times. I think we were getting a rally here as we were getting some more rotation back into U.S. stocks. But here we have the dollar rolling over, probably with the yield set up as we sit here today. And then gold has been trading favorably as a negative correlation to interest rates or to odds of a Fed rate cut. So gold's catching a pretty nice bid as well. So just to let you know what's going on in the market today, the S&P is up 0.88%, having a really nice rally. The Dow is up 0.82%. NASDAQ is up 1%. Our core allocation, folks, is up 0.82%. So it's tracking the broader market almost perfectly. And that doesn't always happen, as you know. We have days where the market's down a bunch and we're not. We have days where the market's up and we're down. It's because we have a multi-asset class global macro portfolio that we're managing. So, folks, I'm going to stop right there and wish you all a great Thanksgiving and probably won't bother you again until next week. Thank you, as always, for watching and listening. Take care. Bye-bye.